In further physical bullion shortage coupled with continued high demand news, another viral U.S. Mint shutdown was reported earlier this week. The first viral closure of the U.S. Mint's high bullion production West Point facility was reported on this channel late last month, March 30th, 2020. Yet here we are, again, only a few weeks later, with yet another U.S. Mint closure announcement with an indefinite timetable of return. The U.S. Mint had previously redirected some American silver eagle bullion coin production to its Philadelphia facility, although what limited supply that facility might produce will likely remain well inadequate to meet ongoing demand. During the temporary suspension of operations at West Point facility, too, both American Gold Eagle and American Gold Buffalo coins will not be available for sale. This now second viral shutdown of the U.S. Mint is actually covered by financial establishment media this time, and thus not surprising to see a further divergence between what we are told the price of silver and gold should be versus what it is in highest bullion demand product reality. Prohibitively more expensive are both the Gold Eagle and Silver Eagle coin prices than their supposed underlying spot price would have you believe at first glance. The most popular bullion gold-silver ratio is now almost half of what we're told by the derivative-driven futures and spot price figures. Hello, this is James Anderson of SD Bullion. U.S. citizens, did you receive your 1,200 Fiat Federal Reserve note bailout check or direct deposit yet? Here was current U.S. Treasury Secretary Steve Mnuchin late last month explaining how long they should last you and in covering your overhead expenses.
But $1,200 takes you a lot farther in Nebraska than it does in California. How do you want people to be spending this money?
Well, there's really three components of this law now that protects the American public, and the president was determined that we protect the American workers since it was not their fault that we shut down the economy while we kill this virus. So the first component is small business loans, which about half of the companies in the U.S., people will be able to get small business loans and pay their workers for 8 weeks. So we encourage people to do that and get them back to work. 2, there'll be enhanced unemployment insurance. And 3, as you said, there'll be these checks in the mail or direct deposit. It's really bridge liquidity for people as they go through these difficult times.
Bridge liquidity for about 8 weeks?
Well, I think the entire package provides economic relief overall for about 10 weeks. Hopefully we'll kill this virus quicker and we won't need it. But we have liquidity to put into the American economy to support American workers and American business.
In the comments below, let us know how long the $1,200 check will last you. Over 22 million filings for unemployment have been made in the last 4 weeks. In a country of about 160 million official workers, that means about 1 in 8 are without employment now. So once again, the private Federal Reserve Central Bank is again failing half of its mandate, with unemployment already in the teens of percentage and possibly headed to 1933 Great Depression levels and beyond, as admitted by their very own Federal Reserve blog, an article of their research department we covered last week on this channel. Billionaire silver bull Scott Menard had some recent thoughts this week on the latest unemployment figures and where this likely bear market rally in the S&P 500 may be headed. Have a listen.
How is inequality going to start playing into a lot of these discussions? Again, with that idea that you believe that there could be rolling shutdowns for 2 years, what does that mean for what you think about the job force in the next couple of years? Do you have an expectation for unemployment?
Yeah, we do. We think that unemployment has spiked up here. We think it's going to be around 14%, maybe a little bit higher, maybe 17%. But I think that initially getting workers back to work, that by the end of the year, we won't be much below 10%. Maybe we can get down to 7 or 8%. And then it's going to be a long haul to get back to the unemployment levels that we saw prior to the downturn. That's why I'm so concerned about a longer term plan to encourage business to get people back to work. But fundamentally, at the end of the day, the definition of how business and government interact is being changed here. And, social inequality, I think, is one of the biggest problems we have, not only just in the United States, but in the world. And, I think government policies have largely ignored the unintended consequences, which have led to this massive inequality of income and wealth. And ultimately, history shows us that there are populist revolts, and there will be a time where the government will address the inequality issue. My only concern is that they'll do it in a way that's not productive for long-term growth, which would be like to raise taxes dramatically rather than work on fundamental reforms in the economy.
You do have this call that you believe the S&P can reach 1,500. And we are on a day where the markets are starting to, bounce back from those lows in March, react positively to any bright signs that we have. How much are you sticking to the idea that we are going to reach new lows here, and how bad can it get?
Sure. Well, let me come at it in two directions. I think one is from an investment thesis. The market at this level, based upon where earnings are, doesn't represent any kind of intrinsic value that's worth pursuing as an investment. It is being entirely propped up by liquidity. My technical work from a week or two ago suggested that near term we could get to 2850, and then we would probably head lower again. If you look at the period following the stock market crash of 29, or you look at the bear market that started in 2007 that went into 2008, both of those initial declines were followed by rather large retracements, in some cases more than 50. So a retracement after a really hard decline is exactly what we should be expecting here. So it doesn't fundamentally change my perspective, Sonali, that the S&P will be meaningfully lower. It could be 1,500, 1,600, 1,200. But there are various ways to calculate the target. But I think that investors who are sitting out there right now who rebalanced a few weeks ago and moved from fixed income to equity should probably be thinking about rebalancing again, because the equity increase I don't think ultimately will be sustainable.
The private Federal Reserve updated their balance sheet this week, but not their Fred chart. Looking at the figures and growth over the last 12 months of time, the Federal Reserve is mainly blowing out their balance sheet buying U.S. Treasury IOUs and extending loans to foreign central banks around the world using fresh fiat Federal Reserve notes drawn from computer keystrokes, which they consistently remind us and the world are infinite in supply. Unfortunately, they have yet to explicitly define for us all what each of these, say, 6.4 fiat Fed note trillion might buy in real-world goods or services, perhaps 10 to 20 years from now. Financial journalists at WallStreetOnParade.com juxtaposed the Main Street versus Wall Street bailout totals ongoing this week on their website. If we add up the cumulative $9 trillion in New York Fed repo loans that have been going on since mid-September last year to now, and the $4.54 trillion in U.S. Treasury Federal Reserve unauditable FOIA-resistant bailout slush fund that recently passed in the CARE Act, we now have a running loan total of $13.54 trillion loaned to Wall Street's primary dealers and connected insiders versus possibly $1.7 trillion for average Main Street U.S. citizens. I'll leave links in the show notes this week for you to read further details on this lopsided story. Finally, taking notes from private Federal Reserve and the U.S. Treasury, the lead lawyer of COMEX's CME Group filed multiple letters with Working Group on Financial Market Member Agency, the CFTC, late last month, citing that the new hardly traded yet COMEX 400-ounce 4GC contract would be protected too by Freedom of Information Act requests. Now, we covered this abrupt COMEX and LBMA rule change collusion just a few days ago in a video entitled COMEX, Gold Fractional Reserves Nearly Double. We'll leave a link in the show notes for you to catch up on that ongoing, desperate, and supposedly unaudible rule change. Meanwhile, the COMEX futures versus London gold spot price divergence continues near 45-year nominal high. You're looking at a chart of the last 2 months or so. While gold and silver investors continue pouring record-sized capital into precious metal funds preparing for the inevitable rise to $2,000 an ounce gold and beyond,
It's only a matter of time before spot prices are forced to reflect this new infinite QE versus limited bullion supply reality. That's it for this week. Take good care of yourself and for those that you love out there.
If you enjoyed this content, be sure to give our video a thumbs up. If you're not subscribed to our channel, do that. And finally, be sure to hit the alert button so you don't miss these market updates as they come along. Give us your comments below. Let us know what topics you want to see more coverage on.